This is MeetSean, where we break down real life topics insurance, annuities, real estate, travel planning, and home ownership so you can make smarter moves. Subscribe so you don't miss the next episode.
Welcome back to the deep dive. Today, we're putting on our metaphorical flip-flops
Ah, I like that.
and diving headfirst into a really big topic for the Florida housing market. We're talking FHA loans.
That's right. And you sent over a huge stack of sources. We're talking articles, government filings, even lender notes,
All of it.
all focused on making sense of this whole process, specifically in the Sunshine State.
And that's our mission, right? To just short-circuit that learning curve for you. We want to give you the key requirements, the specific limits that apply in Florida, and, some of those insider tips to navigate this without getting bogged down.
Absolutely. Homeownership should be exciting, and FHA loans are this huge on-ramp for so many people. They're just a really popular choice, especially for first-time buyers or maybe for people who don't have that perfect credit score.
Okay, let's unpack this then. What exactly is an FHA loan? I mean, how is it fundamentally different from a conventional loan?
At its core, an FHA loan is a mortgage that's insured by the Federal Housing Administration.
The FHA.
Right, and that insurance is the real key here. Because the government is backing the loan, lenders are just more willing to work with borrowers who might be seen as a bit more of a risk.
So you get those big benefits, the lower down payment, more lenient requirements, but there's always a trade-off. What is it here?
There is, and it's the mandatory mortgage insurance premium. MIP, for short.
MIP.
Now, with conventional loans, you might have PMI if you put down less than 20%, but with an FHA loan, this MIP is almost always mandatory. We should really dig into that.
Yeah, let's start with the qualifications because this is where that flexibility really shines. The sources laid out some pretty clear tiers for credit scores.
They do, and it's a system that all FHA-approved lenders use. So if your credit score is 580 or higher, you're in. You qualify for the program's biggest draw, which is that very low 3.5% down payment.
And that's the goal for most people.
Yeah.
But what if you're just under that? You're close, but not quite a 580.
If your score is, say, between 500 and 579, you might still get the loan, but, and this is a big but, the down payment requirement jumps.
Jumps a lot.
It jumps to 10%, so that flexibility is there, but it creates a major strategic choice for a buyer.
Okay, let's connect the numbers to that strategy. Let's say you've got a score of 575. The house you want is $300,000.
Right.
If you move forward right now, you need a $30,000 down payment.
Exactly. But if you were to spend, say, 6 months really working on your credit to get those 5 little points to hit 580, your down payment drops to just $10,500.
Wow. That's a difference of almost $20,000 in cash.
$19,500, yeah. That's huge. That could be the difference between being house poor and having a real safety net.
So that's the trade-off right there in the FHA system.
Yeah.
Your time versus your cash.
It really is. And for a lot of people, that time spent on credit repair is a much better investment. But it's not just credit. The lender also has to verify your income. They want to see stability.
And they look at your debt-to-income ratio, your DTI, right?
Yeah.
That's the metric that shows if you can actually handle the monthly payment.
That's right. It's the percentage of your gross monthly income that goes toward all of your debts, including the new mortgage. And the FHA rules are pretty flexible here, too.
Yeah. A conventional lender usually wants to see a DTI under 36%, but the FHA will often go up to 43%, maybe even 50%.
Sometimes, yeah, up to 50% if you have what they call compensating factors, like a big cash reserve or a really good credit history above, say, 620.
And that's a huge benefit, especially if you have student loans or something similar.
A huge benefit. They'll verify it all, of course. Pay stubs, W-2s, tax returns, and they can even consider secondary income, things like alimony or Social Security benefits.
Okay, let's get into the money details. Specifically, that mortgage insurance premium, the MIP we mentioned, this is where it gets confusing for a lot of buyers.
It is confusing because it's actually a two-part fee. First, you have the upfront mortgage insurance premium, or UFMIP.
UFMIP.
Right. It's typically 1.75% of the loan amount, and most people just roll it into their total loan balance.
And then there's the ongoing part, the annual premium.
Exactly, the annual premium. The percentage varies a bit, but it's divided into 12 payments and just added right onto your monthly mortgage bill.
So if you borrow $300,000, you're paying that upfront fee plus this extra chunk every single month.
Yeah.
How long?
And that's the critical point. If you put down less than 10%, that MIP is there for the entire life of the loan,
The whole 30 years.
the whole 30 years. It's a massive difference from conventional PMI, which usually drops off once you hit a certain amount of equity.
So doesn't that mean most FHA buyers should be planning to refinance at some point to get out of that monthly insurance payment?
That is often the strategic play, yes.
Yeah.
You buy the house with the FHA loan, you build up some equity, you improve your credit, and then a few years down the road, you refinance into a conventional loan to get rid of the MIP for good.
Okay, so now let's talk location, because in Florida, this is a huge variable. The maximum loan amount changes depending on where you are.
It does. FHA loan limits change by county, and it's all based on the median home prices in that specific area. You absolutely have to know your county's limit before you even start looking at houses.
We looked at the data, and the difference is,
Eh.
well, it's striking.
It is. I mean, think about a high-cost area like Miami-Dade. The FHA loan limit there might be around $420,680.
Just because housing is so expensive there.
Exactly. But then you compare that to a place like Orange County near Orlando. It's a growing metro, but the limit is lower, maybe around $314,827.
And then you go somewhere like Escambia County, up in the Panhandle, and the limit could be closer to $294,515.
Right. And that difference directly limits your budget. If the home you want costs more than your county's FHA limit, that loan is it's off the table.
Which brings us to another really important step, the FHA appraisal.
Yeah.
It's a bit different.
It's very different. It's not just about the market value of the home.
The appraisal basically does two jobs, right?
Yeah.
Make sure the value is there, but it's also a kind of health and safety check.
Exactly. An FHA appraiser is looking for specific minimum property standards. Peeling paint, a leaky roof, even a lack of working utilities. Any of those things can stop the loan dead in its tracks until they're fixed.
I remember reading about a rule with handrails on stairs. If a handrail is missing, that's a safety issue the appraiser has to flag.
It is. It sounds small, but these details are non-negotiable for the FHA. They want to ensure the property is safe and sound for the family moving in. If it's not, the lender can't approve the loan.
Okay, so let's move into the actual application process. There's some language here that can be tricky. Pre-qualification versus pre-approval.
This distinction is so important. Pre-qualification is, well, it's just an early guess. It's a rough estimate of what you might afford based on what you tell the lender.
But no guarantee.
No guarantee at all. Pre-approval is the real deal. It's a much stronger promise from the lender because they've actually seen your documents. It sets your real budget and tells sellers you're a serious buyer.
And to get that, you need to provide everything. Proof of income, W-2s, ID, bank statements, the whole package.
You do. And once you submit all that, the typical approval window for an FHA loan is about 30 to 45 days.
What's the biggest thing that slows that process down?
Honestly, slow information exchange. If the underwriter asks for an updated pay stub, you need to send it instantly. Delays almost always come from the buyer not getting that documentation back right away.
Good tip. Now, before we get into the Florida-specific challenges, let's bust a couple of myths. First one, FHA loans are only for first-time buyers.
Total myth. They are open to anyone who qualifies. It doesn't matter if you've owned 5 homes before.
And myth number 2, FHA loans have higher interest rates.
Also incorrect. The rates are very competitive, sometimes even better than conventional rates, especially if your credit score is on the lower side. The MIP is the trade-off, not a higher interest rate.
Okay, let's focus in on Florida itself. Buying a home here comes with some unique challenges.
It does. And the first thing you need to do is choose your lender very carefully. You want someone with extensive experience handling FHA loans in Florida. They get the county limits, and more importantly, they get the insurance market here.
And when you're comparing them, you have to look past just the interest rate, right?
You have to. Look at the total closing costs. Compare everything. Even a tiny difference in the interest rate can save you tens of thousands of dollars over 30 years.
Let's talk about the market here. It's so dynamic.
It is. It's driven by retirees, tourism, seasonal changes. That constant demand keeps prices high, and coastal areas are always going to be pushing right up against those FHA limits.
But the single biggest budget issue for a Florida buyer has to be insurance.
It's a massive cost differentiator. Huge. Because of hurricanes and floods, you have to plan for it. Homeowners insurance premiums have gone way up, and you need to look very closely at the hurricane deductible.
And that's before you even get to flood insurance.
Right. Which is a completely separate policy. If the home is in a high-risk flood zone, your lender will require you to have it. And all of that, the high premium, the flood insurance, that has to be in your budget calculation from day one. It can add hundreds to your monthly payment.
Is there an alternative for buyers looking maybe more in the rural parts of the state?
Yes. If you're looking in a rural area, you should absolutely look into USDA loans. They're backed by the Department of Agriculture. They offer low rates and sometimes even zero down payment for eligible buyers.
Okay, let's wrap up with the final steps before you get the keys. Understanding your PITI.
Principal, interest, taxes, and insurance. That's your total monthly payment. And you have to remember that the MIP we talk so much about is part of that I, the insurance component.
And just to be crystal clear, the home inspection is completely separate from that required FHA appraisal?
Completely. The FHA appraisal is for the lender. The home inspection is for you. It's your detailed report card on the house and your leverage for negotiating repairs with the seller. Never ever skip it.
So what does this all mean? Our deep dive really confirms that the FHA program is this critical path to homeownership for so many people.
It is. But that flexibility comes with real constraints. The ongoing cost of that mortgage insurance and the strict county loan limits here in Florida. Success is really all about preparation and strategy.
So for those of you out there running the numbers, getting ready to jump into the market, we want to leave you with one final thought.
It goes back to that strategic choice we talked about. If you are sitting just under that 580 credit score, you have a decision to make. Do you move now and pay the 10% down payment? Or do you invest a few months in credit repair to hit 580 and only pay 3.5%? The real question is, which asset is more valuable to you right now, your time or your cash? And that decision, well, it's going to shape your entire financial future in that new home.
That's it for today's Meet Sean. If this helped, follow the show and share this episode with one person who needs it. See you next time.